Let us solve one more case study on valuation using two-stage discounting model using the FCFE, FCFE free cash flow for equity. Now, how do we calculate free cash flow for equity, or what is free cash flow for equity? Is very simple. Cash which is available for the benefit of the equity holders, that cash, that free cash flow is known as free cash flow for equity. Meaning what? Meaning, how do we calculate free cash flow for equity? It would mean, number one, take the profit after tax or the net income or the earning after tax or the net profit, the figure of net profit. Add to this cash, non-cash expenses like depreciation and amortization. Then further add or deduct depending on change in the net working capital. So if the net working capital has reduced, that means so much more cash is now available with the company. So that will be added to the free cash flow for equity. In case if the net working capital has increased, in that case we will need to deduct the amount of increase in the net working capital, because that much of cash would have gone out of the business. After that, we will make adjustment for capex. So in case if the company has incurred any capital expenditure, so the amount of capital expenditure that the company has incurred in that particular year, that amount will need to be deducted from for arriving at the figure of FCFE. And in case if company has sold any asset, fixed asset, then the amount that would have been realized from the sale of fixed asset will be added to the figure of FCFE. Likewise, in case if company has taken a fresh borrowing, that borrowing will be part of the FCFE. That means that amount will be added to the figure of FCFE. And likewise, in case if the company has repaid any of the loan in that particular year, that the repayment loan amount will be deducted for calculating the figure of FCFE. So this is how we would make the adjustments for arriving at the figure of FCFE. एक चीज़ आपको ज़रूर बताना चाहूँगा यहाँ पर, क्योंकि एक सवाल जो आपके मस्तिष्क में आएगा वो ये कि इतने सारे एडजस्टमेंट क्यों करते हैं. And that is because, remember, value of a business does not lie in the land or building or property, plant and equipment or current assets or employees of the company. Value of a business lies in its ability to generate cash. So that is how in discounted cash flow method, we always use the future cash flows. And what we do, we use the future cash flows for the future years. And that means what? That means every year's cash flow has to be calculated separately by making all the adjustments that I have just spoken with you. And that is because ultimately we want to find out as to how much free cash flow is going to be available in the hands of the company for the benefit of equity shareholders when we are calculating FCFE. So with this understanding, let us take this a small case, and I would just read it out for you, and I would like all of you also to simultaneously read it. So XYZ Limited is planning to issue fresh equity share capital and has sought your professional advice as to what should the issue price of the company's share. What should be the issue price of the company's share? The company management has shared with you the following financials. Actual free cash flow for equity of the company for the year 1920 was rupees 500 crores. Commencing from financial year 2021, the company expects to pass through a high growth period of 7 years, and that is your explicit forecast period, when its FCFE will grow at the rate of 10% per annum. Thereafter, the growth will stabilize to 4% and will remain so in future, that is during the terminal period. Please remember, terminal period कहाँ से start होता है? जहाँ से एक्सप्लिसिट फोरकास्ट पीरियड खत्म होता है वहाँ से टर्मिनल पीरियड स्टार्ट होता है. Now you have also been given some more information, and that is prevalent risk rate of return, risk-free rate of return is 7%. Beta of a comparable company listed on stock exchange is 1.3, and the rate of market return is 12%. The number of outstanding equity shares of the company as of the date is 200 crores with face value of rupees 10 crore. Of each share. So determine the value per equity share of the company. So now what I would urge all of you, based on our discussion and based on the exercise that we did on our last session, let you try it out for a few minutes and find out answer to this question, that is value per equity share of the company. And after that we will do it together. So in my view, it should not take you say about 4 minutes. So 4 minutes is the time that is available with you. Your time starts now.